Good afternoon, everybody. Welcome to the Trader Merlin Show for your Wednesday edition, probably one of the more significant days of the year because it's the first time we've had a rate cut since December of 2024. A long time we've been kind of steadily going there and staying at 4.5%. Got our cut to 4.25% today, which really came as no surprise to anybody out there. We're going to talk a lot about that today with our bond market update. My guest today joining us from a couch with no camera. He's in his pajamas, folks. We just don't want to do that to our viewers out there. We got Bill Addiss joining us from the East Coast. Bill, how you doing, my friend?
I am doing great. Yes, I didn't want to scare anyone, so thanks for going camera-free today.
Camera-free. Bill's clothes-free today, so I guess camera-free is probably the right idea.
Naked Fed watching.
Oh, boy. Thank God there's no two-way cameras. Walk me through a little bit of your thoughts today. I know that, oops, I had the wrong thing up there. I know that as we progress through this, there's a lot of points that Jerome Powell has made. There's a lot of reasons and justifications he gave for today. But from a 30,000-foot perspective, what was your take on the rate cut and some of the statements maybe at the press conference?
Yeah, no, I thought he handled it very well, as I think he's capable of doing. You know, what initially surprised me was the 25 basis point cut. I mean, who wasn't looking for that? Right. You know, with the exception of Mr. Moran, who wanted a 50 basis point cut. This was pretty well baked into the market. What was surprised me initially was the market reaction. You know, when long-term rates came down at the initial announcement, that really surprised me. We saw 2-year, 10-year, 30-year rates all go down on the news.
Sharply. Yeah.
And, you know, the long end is generally not independent, but certainly has many more variables that affect it. And, you know, if you look back to 2024, when the Fed cut short-term rates by 100 basis points, long-term rates went up by 100 basis points, you know, the dynamic nature of the yield curve. So when the long rates were coming down this afternoon, that really surprised me. But as the longer the press conference went on, and this has happened a couple of times, the more the market reversed itself.
Yeah.
You know, until finally by the end of the day, the 2-year was literally unchanged. So I mean, talk about something being priced into the market. No change in interest rates at 2-year, and the 10-year and the 30-year actually went up about 5 basis points,
right,
which to me makes sense. Because I'm going to come back to the conversation, and I sound like a one-trick pony. We still got an inflation problem.
Yeah, which he did address today. He said it a couple times.
Yeah, oh, absolutely. But he obviously has now put the jobs market as a preeminent issue. And as we were talking briefly, but I think it's worth discussing more, you know, the labor market is both from a supply and a demand point of view. And he pointed that out. So I think they're wise to look at that. But I do continue to sound like the boogeyman saying, look out for inflation. So the yield curve is steepening. And, you know, that's the trade I've kind of been talking about with the OTA community, is doing the spread trading with the steepening trade.
Right.
And for the last week, that's kind of worked against us. The yield curve is actually flattened. But I think now that this is out of the way, I think that steepening trade, short rates coming down, long rates going up, is the way this is going to play out.
Well, which just essentially gets us back to normal, right? That's the way that this should be. We should have it back to normal.
Right. We've been in this dystopian world, Merlin. Don't talk about normal.
Yeah.
What's normal anymore?
I know.
No, I agree. And I like the phrase that Powell said. He called this cut a risk management cut. And I think that's a prudent way to look at it. You know, I'm still hoping and know that the Fed is going to be data determinant. You know, this is not a once and done. It's a once and let's look at it again. But I also think, and I hate to acknowledge this reality, but nothing exists in a bubble. And I think there is a certain political reality to this cut, or let's call it responding to market forces, if that's more politically correct, this cut. It takes the pressure off the Fed a bit.
It does take the pressure off the Fed a little bit, but, I mean, when we talked about this before the show, you asked, well, why did we need a cut? And let me, since my viewers have heard me ad nauseum on this one, I'm curious to get your take on why did we even cut, right? 25 basis points. Did we really need this? Was it appropriate, or, you know, should we have held off?
I don't think it's necessary. I wish, again, if we were in an ideal world of no other factors, I would love to see more data come in to justify what the Fed should do. You know, the fact that we can all have these debates really does indicate there's no clear consensus. And unfortunately, a lot of the consensus then becomes motivated by other things. You know, I'm not of one to, you have to react just to react. But I also understand, let's be honest, Powell's administration has been accused of being late to the party. That's the old transitory inflation going back to all of that. So I think this helps dispel that continued fallacy, because I don't think that's real. But I think it gives them some breathing room. That's really what it is. I don't think 25 basis points is going to affect the economy hugely one way or the other. Let's be honest. I think it just gives them some breathing room.
To what extent do you think that this rate cut was a preemptive measure? Because there's so many people give the Fed a hard time about that they're not proactive, that they're reactionary, and they're always late to the party. And one could make the argument that this might be a little more proactive than they usually are. What's your thought on that?
Right. Yep. No, that's what I'm saying. He knows his reputation is being late to the party, and this helps address that. Everyone worries about their legacy a little bit. He's going out being a little bit more preemptive, but I'm just not sure it's justified yet. I got to get inflation off my brain. I just not sure it's justified yet. You look at grocery prices last month, we're up 5%, 0.5% in 1 month.
Yeah.
That toppled an administration last year. Numbers less than that. Coffee up 20% in 1 month. Car prices. I mean, inflation is an issue. People are feeling it, but they don't seem to be as concerned about it. Or at least the Fed doesn't.
Yeah. Well, for me, I'm looking at it and I feel like the unemployment numbers look fine. Everything felt like it was okay. And then you have the non-farm employment change and that type of data was starting to look a little bit ugly. And it's just the trend is your friend till the bend at the end. And if that data keeps drifting lower, then, why not be a little bit more proactive here? Because they have plenty of flexibility here. And I don't think dropping 25 basis points is the piece that causes inflation to surge and spike up to 8-9%. But, one first baby step at a time.
Yeah, no, I think this is the prudent thing to do. I really do. I'm not here to second guess. I think it was probably, given all of the factors involved, and the revisions to the labor market is really what's scaring people. The quality of this data is obviously becoming suspect in all the revisions. So I think they were a bit more preemptive than I might have liked them to see. I'd rather them to be pure data. But there are other factors involved. I really do believe that.
Yep. Well, here's the updated chart of it. You guys can see the 25 basis point cut there. And again, a lot of wiggle room here for the Fed should they choose to cut more going forward. And, that's something that we'll look at the dot plot here. I'll bring it up, I thought this was rather humorous because we know that Moran, big fan of President Trump. And certainly I think it's almost like he's a spy because he's still being paid by the government being put in there. Here is the Fed dot plot. And you guys can see on the left-hand side is the most recent one for 2025. And you got most of the voting members are there in this nice little cluster. And then you got this rogue outlier here who says we're going to get to 2.75 by the end of the year. Well, that would be another 150 basis points from current levels, nonetheless. And that most likely is Moran right there. And do you have any take on that, on this newbie who's there?
That's his resume builder. He wants the Fed chairmanship. That's his resume builder. That dot plot is to appeal to one constituent.
Yeah, right.
Absolutely. He's laying out where he feels it's going to be or should be for whatever reason. And there was one audience for that dot plot.
Yeah.
Data point.
Saba asked a question.
The dispersion of the dot plots in general, and I'll be honest with you, I haven't had a chance to look at the charts, but I understand if you look at the dispersion of the dot plots, they've gotten much wider. There's much less consensus than there was, 8 weeks ago at the last meeting. And I think that reflects kind of the uncertainty. These are the people who watch it the most. And that's why I say, in an ideal world, I might have liked to have them wait a little bit longer and let's get some clearer view.
Yeah.
But it's taking a long time. The tariff situation just keeps going on endlessly down the road, and we keep talking about it as a tax and a problem. It certainly has not proven to be that distortedly yet. So I think there's a lot of what ifs.
Yeah.
But I think the Fed decided it was time to do something. And I don't think the motivation was just economic. I really don't.
I don't think it was economic. I think it was also a political piece because I'm pretty sure, and I don't speak for Powell. You may have had a chance to talk to him since you teach for the Fed, but
lately.
I get the feeling that behind closed doors, Jerome Powell's sitting there going, "Are you kidding me? Just leave me the frick alone. Stop. Just get off my back, dude. Okay, fine. We'll do 25 basis points, okay? Are you good with that, Trump? Just leave me alone. Bessent, you okay with that?" It almost feels like it's just to appease the masses because, again, 25 basis points isn't that crazy. What I did like is at the press conference, there was a question about 50 basis points, and Powell just said, no one was even entertaining 50
Right.
basis points. And we made the point on the show the last 2 days, because I've had kind of 2 days talking about this as we go into this, which was
Right.
50 basis points would have spooked the market. It would have sent a message that there's something the Fed sees that we just don't see very clearly that they're worried about. And if they are typically reactionary, it would be like an oh shit moment, right? If we did 50
Right.
basis point cut.
Yep. No, they have to act prudently, and again, I'm stressing. I don't think this was economically motivated as others, so they make the political point or the breathing room. We're kind of saying the same thing. It gives them the breathing room that they would like, because I still think there's a lot of data yet to come in relative to this economic cycle. What is going to be the impact of tariffs? How much of this is going to be passed on? But I continue to. I mean, if you look at it, I'm a tradition. I feel like I'm in this dystopian economy here. Inflation's higher than we want, and we're cutting rates. But again, I know I look more at the inflation side than the labor side, so that's my own bias. But the labor market, you can justify it. I don't dispute that.
Yeah. Well, we will see going forward how much of this stuff changes. I'm feverishly working trying to get your images up over here. So I'm trying to make the screen look good, and I'm doing on the fly editing over here. So
I'm a vampire. I don't appear on images.
Yeah,
so.
no, I'm sure the audience is like, what in the hell is going on over there with Merlin? I'm trying to get Bill's shots perfectly set over here. That's my problem for today.
Well,
all right.
while you're doing that, I want to continue to express. I think there's much more upside to the long rates. I'll be honest with you. I was very surprised when the yield on the 10-year dropped below 4% earlier this week or late last week. That was a real shocker to me. I don't feel. I think the curve is really poised to steepen, because even if, let's say, this rate cut wasn't needed, it certainly is going to act as a little bit of octane in the engine, if you will.
Mm-hmm.
And I'm still going to have the one focus of inflation. Or the other reality is maybe we just have to accept that they weren't serious about a 2% inflation rate. Maybe they're going to come out and the next administration or the next, 3% is fine.
Yeah.
How committed are they really to a 2% inflation rate if they're dropping in this environment?
That was my point yesterday. It's like, you can't really be that serious about a 2% target when you're not even close to 2% and you're cutting rates, which should accelerate that rate even higher. It doesn't make sense. Here is the current yield curve over here on my screen, which you cannot see, Bill. Sorry about that. This is the one as of this is as of June 3rd. So maybe this is outdated information here from TradingView. And you think that yield is going to start to surge back up for the 10-year? Why do you feel the 10-year is going to be going up when right now it feels like the trend on it? And I'll bring up the trend of the 10-year. Here's the 5-minute. We'll go to a daily. We've got this what looks like downward pressure starting all the way back at the beginning of the year.
Oh yeah, no, I mean to have rates go from 4.55 where they were to below 4%, there's been a dramatic downward shift trend to those longer term yields. I don't dispute that, but I also I heard people using the term this morning on Bloomberg, about various asset bubbles.
Yeah.
And I would make you the argument that the equity market might be part of that. But they're talking about a bit of a bond bubble, if you will. Now, again, I hate using the term bubble because just because something's overvalued doesn't make it a bubble. A bubble is a bubble because it pops.
Yeah.
So, I do think, though, we've got asset overvaluation going on. I really do. But I sound like a one-trick pony. With the growing concerns that I have about core inflation going up, on every category, that's going to put upward pressure to long rates. Now, the good news is, and this is something I wish I could get more information on, the result is the tariffs will help with the deficit problem. And, my big contention last year was one of the reasons we saw rates going up so much was just the overabundance of supply the U.S. government had to sell to finance the ever-burgeoning deficit. The tariff will help that situation. So we'll have to see. Maybe we won't get the amount of upward price movement or yield movement we normally would see in an inflationary environment, because we're not going to also be hit with this overwhelming amount of supply, which was our problem back in 2024.
Right. Well, you say that because the tariff obviously is another income stream for the government. However, the absurdity of a comment from our elected officials that, businesses are going to eat all these tariffs and it's not going to be raising prices, that's just absurd. We all know that that's not true.
Absurd. Yeah.
So, yes, the government now has a new source of money, but it's not trillions of dollars. It's, in the B's, the low B's, $1 billion, maybe a couple billion. But does that really make that big of an impact? That, when you look at the bond auction, what would you say is an average sale at a bond auction? How many billions?
Well, on the 10-year, we do about 36 billion, pretty monthly, up or down a little bit.
Okay. And if we offset some of that from tariffs, I'm gonna see how much has the government.
And then that's monthly. Yeah.
Yeah, in tariffs. Just curious what Google says. It says right now, the government's collected over 183 billion in tariffs since the beginning of the year. That's what it says, right? And don't shoot the messenger. This is with AI, so who knows how accurate it is. But even, at 183 billion, that's just a few months worth of auctions. So yes, it does offset to some degree, which means the government will be selling maybe some lesser amount of long-dated maturities. And if that happens, then if you have the same amount of demand chasing fewer products, right?
Right. Yep.
I don't know. I just think that the overall impact of inflation is going to be, it's like we're skewing all these different components at the same time and trying to anticipate what that reaction is going to be. Like if we change one thing, I could figure it out. But you're changing this number and this number and this number and tariffs and all this other pieces, it makes it real difficult to anticipate where things are going to go.
And that's why I think forecasting is so hard. Economic forecasting in this market, in this environment, is almost ludicrous because literally, as you say, the numbers keep changing every day.
Right.
We still don't know what the tariff rates are with some of our major partners. So, we're dealing with a lot of speculation here still. I do believe in my soul, though, that tariffs are a tax.
Yep.
And, we're going to pay the price of that. And the only good news I see about that, and I was looking for a glimmer of hope, is it will have a positive impact on the deficit. Not a huge impact, but at least it's helping the numbers in that regard. That's the only positive I can see about all this silly manipulation that's going on.
Yeah. Great question from Big Abby. He says, Bill, why is the Fed inflation target 2%? The historic U.S. inflation rate since 1914 is 3.29. It does seem somewhat arbitrary, and not that it's unreasonable. Obviously, 2% is just a number they threw out there. But do you know some of the justification as to why they chose that 2%, Mark?
I've actually heard that question come up I sound like a geek, but an economic symposium. And apparently the 2% number was thrown out by a member of Powell's staff at the start of his administration. And somehow the number just stuck in terms of the Fed meetings. The inflation number is only important relative to your GDP. You can't look at inflation not in context. So, for example, in India right now, a 6% inflation rate is acceptable.
Right.
And the government the Fed is central bank rather, is comfortable with that because the GDP rate in India is growing at 8%. So, if your GDP is growing greater than your inflation, you actually have positive economic growth, not just manipulated economic growth. So, here in the U.S., we've been running GDP, between 1.1 and 3% for, the last decade probably.
Yep.
With variations. So the 2% kind of fits into that scheme. If we were to get into a hyper economy where, AI, give a factor, whatever. If GDP started running at 5% here in the U.S., I guarantee you the Fed would be comfortable with a much higher inflation rate. I have to point out to everyone, we like inflation. We want inflation. We need inflation. We all want inflation. We want our salaries to go up. We want the value of our assets to go up. We want, we want inflation, but we want it at a manageable level. Well, what's manageable in the U.S. right now is a different definition than what's manageable in India right now.
Mm-hmm.
So 2% is kind of it's the number that's stuck to the wall, is what I heard somebody say.
Yeah, and I've got the chart up here. This is from the Summary of Economic Projections, which you guys can download. Just type in, SEP paper or document, and you'll get it. So if you look at the chart here, it says change in real GDP. It looks like the median forecast, right? The median projection is just under 2%. And today, Powell did say that their target, the consensus, is 1.6% this year, 1.8% next year. So based off the math that you just gave us, Bill, this would be economic contraction, right? Because you got inflation that's, let's call it 3%, rounding error. I know it's 2.7, 2.8, 2.9, whatever, but I'm just going to call it 3%. Yeah. And you've got GDP at 2%. You've got a 1% negative delta there between GDP and inflation, which is not a good thing.
No. And that's why I say I'm stammering because I guess being redundant. The inflation numbers relative to the state of our economy do not look good.
Yeah.
You can basically make the argument most of our economic growth is driven by inflation. As you said, the delta's one.
Yeah. Well, so then we're in a bit of a conundrum then, because really what we got to do is we got to figure out one way to increase our GDP, which I would contend that a weakening dollar could help that GDP, right? Because if your dollar declines, you're selling more goods and services, therefore your gross domestic product increases. So we look at the,
Yep.
I'll bring up a picture of the dollar index here. Here's your Dixie, which has been looking decent. It's been selling off, getting weaker and weaker and weaker. So that actually does support an increase in GDP going forward, which of course would be
Correct.
good. So if we can get GDP to get above that rate of inflation, then things start to look a little bit better for the U.S.
Exactly. Exactly. And by the way, you probably saw it. The dollar, as expected, dollar took a pretty good hit this afternoon, particularly relative to the euro.
It did, but it bounced right back.
Did it again? Again, I noticed everything else bounced back.
Everything
I
bounced
didn't
today,
follow
yeah.
up.
I'm bringing
Yeah,
up. Let me
okay,
bring
that
up the
was-
Euro USD here. Here's the Euro USD. So yeah, it was a big surge up in the value of the euro, and then gave it all back.
Powell's got to learn to keep his mouth shut. The markets react one way, and then he starts talking at the press conferences, and the markets completely turn around. This is not the first time this has happened.
Yeah, and I'm bringing up the 10-year yield again because I thought this was interesting too. You pointed out just the way that it swung today was very interesting. I mean, right as the announcement came out, the yield on that 10-year went from 4.058, call it 4.06, all the way down to a low point of 3.992. Very fast decline, and then it just slowly started to eat its way. Actually, rather quickly, gained all of it back and then some, and now we're higher than that initial announcement. So very, very volatile, not just for equities, which you guys saw. Here's the S&P 500, so you can see the volatility there, but certainly for bonds as well.
Yep. Yeah, and then the long rates did the same thing. We're finishing up today at a 468 on the 30-year, and we were at a 455 right before the announcement. So, yeah, long rates finally are doing what I expected them to do today.
All right. Increasing bond yields. Now, for me, I'm looking at this as not necessarily a good thing because I've been talking about the trend here of this 10-year, and if that 10-year keeps getting lower and lower and lower, that's good for economic growth, right? Cheaper money, and people are going to qualify for more home loans.
Absolutely. Mortgage rates lower, everything.
Yeah. There are some that are printing in the fives, according to one of my real estate buddies, but that may be short-lived if what you think is going to happen happens.
Yeah, but I do want to reiterate because, and I blame the press for this, and your audience, I've been always impressed by the sophistication. I want to caution people that, what the Fed does has negligible, not no, impact to long-term rates. And I say this because in one of my focus classes last month, one of the participants was talking about last year, he was frustrated. He was looking to refinance his mortgage, and he was waiting for the Fed to cut rates.
Mm-hmm.
And sure enough, the Fed cut rates, and he was being patient. And then by the time he looked again, long-term rates were now up 1% from when he started. He would have been better. So, I got to point out the yield curve is very dynamic, and the short end responds to the Fed, as we saw today. Long end responds to other factors, and that's where it's starting to get a little bit nebulous. Well, what is the supply of treasuries going to be? I'm going to throw out something we've also surprised by is the huge demand globally for U.S. treasuries.
Mm-hmm.
We saw a bid to cover ratio on the 10-year for the last auction. That was the best we've seen in I think it was 3 years. So globally, in spite of everything that's going on, investors globally are still rushing to buy U.S. treasuries. The bid to cover ratio was like 2.73 on the last 10-year. It was way high. So we had almost 3 times as many buyers as we actually had treasuries to sell. That strong demand will help push long rates down as well, obviously.
Yeah, absolutely. He cited a couple different things here in this press conference, and I think he was grilled a couple times on this. One was where he talked about the risks to inflation are increasing. And we all know that because of the tariffs and just the uncertainty of what's going on there. And then he said, and the employment situation looks like it's weakening. Those are two of the primary components of your dreaded S word, stagflation. Now, the only other variable that we'd need in there would be to have GDP and have a declining GDP, which we'll get our GDP reading next week, I think next Thursday. Did you get a sense that Jerome Powell may have been a little more concerned about the possibility of stagflation?
I'm surprised that the topic didn't come up more in the press conference. I really am. Because for those people who are so inclined, you can still set up a pretty interesting stagflation argument. And I think this is proof of it today. The Fed has to decide which mandate they're going to look at. Right now, they're looking at the labor situation, and they're saying we're not going to worry about inflation. when inflation starts becoming a problem again, they're going to have to switch again.
Yeah.
This walking the tightrope that they have to do, and they've always had to do it. This is nothing new. This is since 1988 when Congress passed that law giving them the dual mandates. This is a tightrope that they've always had to walk. But these conditions, man, you can set up a pretty good stagflation argument, I'm afraid.
Yeah.
Let's face it, at 1.1 GDP, that's not a huge GDP growth.
No.
That's nothing to be crowing about, that's for sure.
Yeah, definitely. One other thing that struck me during the press conference, he talked about a curious balance. And I like that he used that term because, when he talked about employee demand declining and job demand declining, he seemed perplexed on that. And kind of like that he didn't quite understand why, and he thought it was immigration. He thought it was just, slowing U.S. economy. Did you take anything away from that, his curious balance comment?
I think anyone looking at that from a traditional economist point of view is going to be scratching their head a little bit.
Yeah.
You would think with less workers there, the unemployment rate would go down. And it's I'm not trying to say we're in a screwy world, but boy, are we in a screwy world.
Yeah.
A and B usually equals C, and that's just not the case here. So that's why I say I don't blame the Fed for doing the quarter point cut. There is an uncertainty around the labor market, and maybe Powell's feeling it's better to get a little bit in front of it, and at the same time giving him that all important breathing room. But that really doesn't make sense. The fact that both of those are weaker.
Right. Yeah. Well, he said lower immigration and lower labor force participation too, and that's the interesting piece. We've been looking at that the last couple of weeks here, where you look at this the jobs data and like, when you have that trend, which is clearly down on non-farm employment change and ADP, the unemployment rate overall is not that big a deal, 4.3%. That's historically fantastic, but that could be the shot across the bow that's going to let us know that we could be in a much worse situation down the road.
I do have to put in my usual pessimism, though, as a bond guy, is whereas the unemployment rate itself has remained relatively stable, as you just said, the participation rate has been declining.
Yeah, right.
And that's a number that I look at a lot more significantly, quite frankly.
Yeah.
Labor force participation is down for the last, I think it's 3 months, but at least 2.
Yeah, I don't have the chart here for that one, but I was looking at the SEP. I think has that number in there somewhere, but
but that number is not going in the right direction. Let's put it that way.
Yeah. Steve asked a good question. He says, "Do the short-term treasuries being bought by by the crypto world have any effect on the 5 and 10 year, or are they totally separate with zero overlap?"
Merlin, I'm going to defer to you on that for a little bit because number one is you were one of the first to, I think, highlight so dramatically that the asset backing that's required for the stablecoin market is going to be huge demand for the treasuries. And it's, philosophically, academically, I 100% agree with you. Mm-hmm. But I haven't seen a breakdown as to what treasuries they're actually buying. Have you?
Yes. So based off the Genius Act,
I know the answer.
Yeah, based off the Genius Act, which is, we're still kind of getting the final details of it. They have to buy 90-day or less maturities. So this is 3 month or lower. So in my opinion, Steve, it has zero impact on the 5 and the 10 year. Yeah. None. Now, when I was mentioning this huge influx, this monumental amount of new buyers, look, you have Tether, you have USDC stablecoin, but you're not seeing a big influx yet, right? Once these rules change, which will be next year, and we get the full implementation, then you'll start to get companies like BlackRock, like JP Morgan, like Amazon, like Microsoft, all starting to issue their own stablecoin. Now, when that happens, now you're bringing in a whole new wave of buyers that have to be in one of 3 instruments. They have to be in US dollars, which is going to be kept at a US financial institution, regulated financial institution. Number 2, they're going to have to buy treasuries with a 90-day maturity or less, or they participate in the repo market and some combination of that. So I think next year you'll really start to see this yield curve, the short end of this yield curve, drop significantly. And a lot of it will be due to these short-term treasuries. The demand's going to be so high. And it's not this 2 year that you see on my screen here. It's going to be this 1 month and your 3 month.
The other term you're starting to hear, and I heard it a lot today, the other term you're starting to hear is that maybe the treasuries should start looking at asset and liability matching. And that's just a way of saying that the Fed, that they can be involved in yield curve control or yield curve manipulation. And, the Treasury historically has claimed they don't play the game of, if short-term rates are low, we issue a lot of short-term. If long-term rates are high, we avoid long-term.
Right.
That for liquidity purposes, they try and offer kind of a fairly constant stream of maturities into the marketplace. Well, if we take this argument, and I think there's a good validity for it, if there's going to be strong demand for short-term treasuries, it would certainly make sense for the Treasury to issue more of those relative to the long term.
Right. Yep.
And that also could drive long-term rates lower because you're going to have less supply in the long rates. So if you hear the talking heads or Treasury officials start talking about asset and liability matching, they're really talking about yield curve manipulation.
Right. Yeah.
And I think that's quite possible. I think that's quite possible. And I would almost recommend they do that. It drove me crazy. Back when long-term rates were at 2% during the pandemic, my argument was load up the boat.
Yeah.
Issue as much long-term paper as you can if we're borrowing at only 2%, and they don't play that game.
Right.
I kind of wish they would.
Yeah. Another question came through from Steve says, aren't they going to have to increase the amount of short term? Is there any downside to that? Will it be forcing the short term to near zero with that much demand? Yeah. It will lower those shorter term interest rates, which should be an economic driver and anchor that short end of the yield curve, which keeps us from going inverted again, which would be a good thing. And like I think Bill was just mentioning, it may get to the point where if those yields for your treasuries are, the short-term treasuries 3 months or less are going to be, 0.5%, well, the government's going to issue a lot more of those as opposed to something that might be longer term.
Yep, and I don't have a problem with that. I mean, some economists, and I'm not an economist, but some economists or market people don't like the idea that the government, the Treasury Department, is going to play that game of let's issue where we get the cheapest funding. But I can see a certain validity for that, particularly if there's going to be the demand from the stablecoin market that people are expecting.
Yeah.
Let's feed that demand.
Why not? I mean, especially if it's going to save the government a ton of money, I think we'd all be on board with that. The only issue there would be it's a short-term savings, not necessarily a long-term one. And if we can keep
therein lies the problem.
Therein lies the problem, right? So there certainly needs to be a mix of maturities that are purchased for this. But the other question here, Margaret asked, which I can answer real quick. Margaret, where did it go? She says, why 90 days or less? If you look back at the failings of Silvergate Bank, Signature, there were a bunch of different banks that went under. What was their major problem? These banks were taking customer deposits, paying 0.01% interest, and then going and buying 10-year bonds and getting 4 or 5%. The issue is because they have such long-dated maturities, if those rates fluctuate significantly and the bank is forced to sell, it could put a lot of undue stress on their system. They could be forced to sell those bonds at a loss, which is what happened to those companies. So I think brilliantly, as they should have done, the people who came up with these rules for the Genius Act said, look, we don't want you to have that long-term risk exposure to long-dated maturities. So let's do 90 days or less. Therefore, if there is a run on these stable coins, there shouldn't be as much damage. Now, there probably won't be a run on them, but I think they just removed that variable, and I think that was a very smart choice.
It was a brilliant decision because exactly as you said, if you've got to liquidate those treasuries, if you've got long-dated treasuries, there could be a lot of volatility to them. Rates go higher, you're going to get less for those treasuries than what you paid for them, which means they're not really back to 100%. Market forces are driving the price of your treasuries down to 90% on the dollar. There's a loss there. Yep. By doing the shorter treasuries with less duration and less volatility, they've eliminated that risk. That was well thought out.
Yeah, absolutely. And Big Gav, you got another good point here. I think part of our job as traders is to look and see, okay, if this domino falls, let me look 8, 10, 15 steps ahead and see how it all cascades down to the other pieces of the puzzle here. And he says, I heard that the lower short-term yields will shave $3 to $4 billion off of Berkshire Hathaway's earnings next year. Yeah, because he's in so much of that short term because it's paying great, and if all of a sudden that goes from 4% down to 0.5% or something, yeah, he's going to lose some money, and that might hurt Berkshire Hathaway's bottom line. So definitely thinking outside of the box, but let's be fair. I do believe that if we got to the point that those short-term maturities are paying, let's say under 1%, that he will probably deploy some of his $350 billion that's sitting in cash into the equity market somewhere. He's going to find a better place to do it, but he's just being opportunistic because he feels that 4% right now is a decent rate of return for over a third of a billion.
And I do have to point out, because as we talked about, this is not unexpected, this cut in rates. I've been talking about these short-term treasury ladders, doing that 1 month ladder and just keep rolling them. And we talked about the vulnerability to that strategy is when the Fed does in fact start cutting rates. And here we are. So for those people who have enjoyed the high income from that 1 month treasury you saw on your yield curve, it is now time, and it was time before now, to start extending those maturities. If you believe that the Fed's going to be cutting continually, you got to extend your maturities out beyond the 1 month. You might be giving up a little bit yield now, but over the long term, you'll be locking in today's yield for a longer period of time. So that latter strategy, which has worked so well for us for over a year, time to start thinking about some maturity extensions there.
All right, maturity extensions coming up. Margaret asked, is the Fed still buying mortgage-backed securities? Are they still propping up this housing market?
They still are, and that is funny. Margaret, that's the second point Margaret's made that I was going to address. So Margaret, we're on the same wavelength. Because the thing I wanted to talk about was the fact that the Fed is still tapering. At the same time that the Fed officially now is easing, right? They dropped the rates. The Fed is also doing quantitative tapering. They are continuing to destroy about $30 billion a month from their mortgage portfolio. Now, they are still investing in new mortgages because a lot of months they have more than $30 billion comes into that portfolio. So they're destroying 30 billion, but they're reinvesting the balance. So yeah, many months the Fed has continued to be in here supporting the mortgage market, which someday somebody's going to have to explain why.
Yeah, I didn't catch any comments on that one. I was expecting to hear someone say, Steve Leisman, like, oh, why are you still buying? I guess they just don't care, right? If you're going to keep propping up the housing market, I'm not going to rock that boat.
Yeah, right. But I just think that the tapering has never been a part of the monthly discussion, the meetings themselves. It very rarely comes up. And even the announcement they made, remember when they said they were going to continue tapering until February?
Yep.
They made that announcement away from an FOMC meeting. So it's almost like they're trying to keep the topic of tapering away from the FOMC meetings.
Funny.
But they're going to continue to taper until February.
Oh, well, we shall see if it stops then. Sava says, what's Bill's thoughts on the administration wanting Fannie Mae going public again?
Should have been done a decade ago. And the real question I have is, why is it taking so long? I mean, every administration since 2008 has said we're going to IPO off and we'll spin off Fannie and Freddie. The government had to nationalize them during the Great Recession. They've owned them all this time. And, the one who I thought was really going to do it, quite frankly, was President Trump's first Treasury Secretary in the first administration was Steve Mnuchin. Mm-hmm. Because Steve had been very vocal that the government doesn't need to be in the mortgage business. And as Treasury Secretary, before he was Treasury Secretary, he said that was going to be a priority. And then once he gets in there, that administration also didn't do anything. Sure. Obama at the end of his administration didn't do anything. Biden. So, and it concerns me because I'm worried about why are they afraid to do this? In other words, in the back of my mind, I'm thinking, okay, well, obviously you do an IPO, you have to give your last 5 to 10 years worth of financial history.
Yep.
We're going to get a degree of disclosure to the mortgage crisis that we have never seen before once Fannie and Freddie do their IPO. And maybe they're afraid of spooking the market as to just how bad things got. I don't know. But no Treasury official has given us an adequate explanation as to why this is taking so long. So I firmly expect they're going to merge Fannie and Freddie into one institution. I mean, there's such a redundancy there. We don't need those two. And I do expect the IPO to happen at some point. I think it should happen. I don't think the government needs to be in that business. We can still provide a government backing, much as we did before the financial crisis. But we don't need these two financial institutions directly under our Treasury Department. Why it hasn't happened sooner than this, nobody can get an answer.
Yeah, and I agree. I feel like there is just shady stuff that could be happening underneath the surface that we don't see. And you're right. If they do go public, that stuff will come to light. And it's not quite as it may not be as bad as the Epstein files, but it's still
another distraction. Maybe we need to do this as another distraction. But yeah, I worry that maybe the crisis was so bad they're just kind of afraid to point out just how fragile the system was. And maybe that answers the question that Margaret asked earlier as to why is the government continuing to support the mortgage market?
Yeah, right. I mean, because you have to have the American people feel warm and fuzzy. You have to have the American people feel like they're making money, that their wealth is growing. So, I mean, that seems to me to be the logical reason. You keep propping things up, everyone's happy, and I just always wonder, like, when does that wealth building push run out? And Oliver's going to give me a hard time about this one, but at what point do we stop seeing the government prop things up and we got our big crash? Because if you look at the chart of the market, let's say S&P going all the way back into, I don't know, pick your year, in 1970, 1960, The rally we've had since 2009 is just it's an outlier. It's a monster outlier.
Yep. I also have to point out, and here I'm being the politically cynical one, we do have to remember that the Fed is owned by the banks.
Yeah, right.
That's their owners. So the Fed is simply working in the best interest of its owners here, I guess you could say.
Yeah. All right. So, Bill, I know you're hobbling around right now, and I hope your knee is doing much better. You got some upcoming classes here for us? You got some teaching going on?
Well, unfortunately, because of the surgery and so on, I had to postpone my focus class and XLT for the month of September. They were supposed to happen last week, and the surgery came about. So I'll be back on schedule for October. I know on October 10th, we're going to do a focus class, the one-day fixed income comprehensive class. And then I think don't quote me on this, I think it's the 18th. And on the XLT, I'll tell you right now, we're going to be talking about spread trading. The steepening trade, using the futures markets, trading the 2-year against the 10-year, look at the profit and loss opportunities there. But I think spread trading is the way to approach this market. And I think the steepening trade is going to be the way to play it. It's hurt us for the last week, but in the long term, I think the steepening trade, for reasons we've been discussing here, is going to be the trade. So we're going to do some spread trading in October on my XLT.
Nice. Well, I can see Friday is a typical application session. If you go to Trading Academy and log in there and go to your calendar, you can just type in Addiss and you'll see all his upcoming pieces here. He's got an XLT general session on October 15th. He also is doing his full focus class on October 10th. So there we go.
Good. Thank you.
My pleasure.
I'll be in fighting shape for it. I'll be ready.
I'm sure you will. Well, hopefully get back on the road and teach physical classes here again soon.
I welcome it. I had a busy summer of travel, and I enjoy the road. I welcome it. Any opportunity, I look forward to it.
Nice. Well, hey, I appreciate you coming on. I'm glad you're doing better, and hopefully we'll be playing kickball soon. You do owe me a few beers, so at some point we got to pay up on that.
I'm going to make it out there yet. I'm going to make it out there yet. Yep. So we'll collect shortly, I promise.
At some point we'll get there. All right, Bill. Hey, thank you very much. I appreciate it. Hope you have a fantastic remainder of your day, and we'll talk to you next month or so.
To you and the audience, have a great day. Thanks, Merlin.
You too.
Always appreciate the opportunity.
My pleasure. Thank you. Bye.
Be well, guys. Fun now.
Guys, that was Bill Addiss. You can find out more information at Trading Academy. You can also go to his website. He's got let's see if I can bring it up. It's Amherst Financial Training, aftraining.co. He's got some videos there. He's got shops and some books that he had there. So that's all that goodies. If you want to sign up for his classes, though, you go to Trading Academy. Of course, you guys know how to do all that. And that's through the Trading Academy website. And as always, good information there from Bill today. Love it. All right. What did I want to get into? Just a couple market updates we'll go through and obviously look at what happened in our markets today. I'm still going to use the futures even though they have that really awkward gap, I know. Bitcoin. We'll start there as our worst performer. It just erased all of yesterday's gains. And, that's obviously going to be somewhat interest rate sensitive. I was actually hoping we'd have seen a little bit more of an upside move here because of the 25 basis point cut, but it was actually down 1.08% to 115,825. But still not looking bad, right? We've had 4 days in a row where it kind of feels like it's just gone sideways. That's great. As long as we held that 115,635 level, I feel okay with it. I feel confident. Crude oil was our next victim, down 0.73%, but nothing really that outlier here, right? It just feels like we're just hovering sideways, so I don't have anything really to say on crude oil. NASDAQ, on the other hand, down 0.23%. This was a great one. You had a really negative day at one point. When that announcement came out from Jerome Powell, the markets dropped pretty handily. And we were down 1.14% at one point and, finishing down just 0.23. That's not bad. We erased quite a bit. And I know that several of you were short on the S&P, which we'll look at here in just a second. At some point, they had some nice profits going on those shorts, and all of a sudden, just gave it right on back. So NASDAQ down 0.23. It still looks very bullish from a pattern perspective. We've got this big hammer formation, long bottoming tail. That's momentum, look like it's to the upside. So that does feel rather good. Now, gold. A lot of volatility, big intraday volatility on this one. We mapped this out yesterday as potential trade once it broke out the zone, and man, this would have whipsawed you and broke your neck on that one, how volatile it was today. At the end of the day, though, down 0.2% to 3,718.8. Fourth place was your S&P, and again, I think several of you had short positions on this one, which we'll see how they pan out tomorrow. It seems like people feeling pretty optimistic about Jerome Powell's comments at the press conference because we started to recoup as that press conference was going on. S&P was down 0.13% to 66.58, and now it's podium time. Obviously, interest rate sensitive products like the dollar and the 10-year yield were the most volatile pieces. You had a gain on the dollar index of 0.37. I still am a believer that we're going to be headed lower here, even though we did come into this lower demand zone, which it knifed through it today. But that goes back to July 1st of this year. I still feel like the bigger picture is pushing prices lower for the dollar, which should act as a catalyst to the upside for the equity markets. So neener, Oliver. That means bullish on the markets. Even though I believe we're headed for a crash at some point, I still think bullish right now. Trend is your friend to the bend at the end. Russell 2000. Almost 1% gain, 0.99, but look at that long topping tail. With that long topping tail, where did it bring us to? All-time highs. So finally, the Russell recouping all of that and dropped it right back up to all-time highs, or ripped it back to all-time highs. However, look at the pattern. That is Halley's Comet. If you're looking at candlestick patterns, I mean, this is a shooting star. Granted, you'd like to see the real body a little bit lower. If that is in fact the case, then I would be looking for something where the Russell opened up above 2,407 and then started to sell off and break that. Once that does, then that could be a really nice short opportunity. But man, it was really interesting to see that about face for the Russell, because remember, the equity markets were selling off and then ripped back up. In this case, the Russell ripped to the upside, had a huge green candle, and then gave it almost all back. So interesting one there. And we've already talked about that 10-year yield. And there she blows. Big, nice up move today. 1.36% jump in the 10-year yield. 4.087. And Bill thinks it's going to go higher. For right now, I'm thinking it's going to go lower just because that trend is still there. Until we break a pivot high, I still think that the prognosis for that 10-year is going to be going lower and lower and lower. Now, what else did I do today? I did make one trade. Where was my scorecard here? Yes. So here's the new addition. How low can you go? On the 10-year, a lot lower. Can go a lot lower. So there's one addition I made today. That was on NVIDIA. I sold some puts on NVIDIA today, and that was at the 166 strike price, and you can see why. It was basically, I'll put the 166 level, on your screen here right now. There is the screen. And let me type this bad boy in here at 166. You can see why I chose that level. It's just really kind of deep. It's down below that choppy zone, which is honestly, it's no longer relevant. We've knifed through that many times. But if we were to modify this and put it kind of where it should be, which is here, between 168.03 and 164.07, it's the middle of that zone, which is why I sold the 166. As I actually would be fine owning NVIDIA at that level. I sold them for Friday, as you can see here. That was for the 919. So closing Friday. I only collected $1. So not a ton of premium, but it's still, $1 on $1.66. What's that? About a 0.6 or 0.7% rate of return for 2.5 days. I was okay with that, and I'll update you guys on Friday. As you can see, I have two positions for MicroStrategy, or one for MicroStrategy, one for NVIDIA. And then I also have the UNH and the SMCI that expires next week. Margaret wants me to answer. Gabe Ramon. As a beginning trader, where can I look on your page to start learning and studying? I don't really have anything on my page, but I would encourage you, Gabe, if you want to use my channel, which is Trader Merlin, you can go to the YouTube page, go to Trader Merlin's YouTube page, and search under all my videos for just topics you're interested in. How to get started in trading, how to build a trading plan, how to succeed at trading. Those will be a good framework for you. I have a lot of videos on that type of stuff, Gabe, but they're not really organized. I have never really organized my YouTube page. As you can tell, there's over 1,000 videos, and most of them are live daily content. Some of those I should just take out and keep them as evergreen pieces. But Gabe, I would type in things like how to become a successful trader on my YouTube channel, how to get started in trading, the beginner trading tactics, things like that, and you'll get a lot of videos there. All my shows are live. I don't do pre-recorded stuff, so all the shows are live. So take that for what it's worth. Most of the people out there do these long-winded, highly produced, in the studio type things. And yeah, there you go. I also do bar chart articles. Yeah, I did do bar chart articles. So I can, if you go to my on my page, which by the way, Big Eb, I have disappointing news for you. Let's go to Trader Merlin, tradermerlin.com. This should have been updated, so you can watch the live one. If you go here to recent articles, Gabe, this will show you some of the articles I've written for bar chart, and some of these might be interesting to you as well. These are more specific about markets, and they're rather old, I'll give you that. But if you go here to the guest schedule, You'll notice that today we had Bill Addiss. Tomorrow we've got Mike Larson, who's the VP of the Money Show. We'll talk about just broader markets, interest rates. And then next week, I'm going to only do Monday. Monday is like the only show I'm going to do next week because I'm going to be gone all week. Tuesday, Wednesday, Thursday, Friday, and it's all posted right there. I will make it a point to update this as we go, but yeah, I was going to be gone that whole week. Crazy. Bummer. I know. But you wanted it, Big Eb. Tomorrow will be show 1200. It was funny because it just seems like we just did the 1000 show. But we'll have Mike Larson of the Money Show on tomorrow. That'll be an interesting one. Looking forward to that. And then tomorrow I'll also tell you about on Tuesday morning. No, not the Orlando trip. Tuesday morning, I am going to be doing a presentation for the Money Show. It's an online thing. I'll give you all the information tomorrow. I just haven't had a chance to put it all together. That presentation is all about cryptocurrency red flags and how to avoid scams. So that's something they asked me to do, so I'm going to do that one. Nope, not going to NorCal. If you really want to know, there's a thing called Wasteland Weekend. So some of my really good friends, as you guys know, I've been going through a pretty emotional, tough time mentally and dealing pretty good with it. You know, I still don't want to admit that this whole thing is done and over with. It's hard for me to believe. But just as a way to get out and go do something fun, some of my friends go to this thing called Wasteland. And basically it's Mad Max, Road Warrior type stuff with the cars, the spikes and fire. And it's just crazy type stuff out in the middle of the desert somewhere. And that's where I'm going. You're losing some more weight? No, Rob, I'm not losing weight. I'm just gaining muscle. I'm getting better, actually. I'm just leaning up a little bit. I left my first review that I've left for a business in a long time. And I started doing this F45 thing. I did it a long time ago for about a week, but it's been really good to just take back control of my health. So since emotionally I'm just a wreck because of the breakup, you know, at that point, you have to take control of things that I can control. I can't control what she does or what she thinks or how she acts. What I can control is my part. So right now, I'll tell you what's going on in my head, and I know you guys have heard this from me before, but I have so much going on for the month of October and September. I've got my friend in town. He leaves Monday. I leave Tuesday for this Wasteland thing for a week, and then I come back. And I think at that point, I'm going to spend a lot more time accomplishing goals that I've been wanting to do for a very, very, very long time. And you all know I've been trying to write this book. I just get frustrated with it because it's boring to me. I have it on my plate that I am going to finish this, at least the one book, hopefully by the end of the year. That's my target. I'd like to do it sooner if I really sit down and focus on it. So, you know, as I'm going through this transition phase in my relationships and, you know, hopefully finding Mrs. Rothfeld at some point, a deserving woman this time, you know, I need to take care of myself. So one thing I've been doing a lot, and I would encourage everybody here to do it as well, if you're one of those kind of complacent people that just kind of sits there and goes, I should work out, join something like F45. I've done F45 now this is my third week, and I mean, the improvement in my physical health, my mental health, just the confidence I have about myself is incredible. It is really, really good. So, you know, it's not cheap, but it's community. It's about working out and taking better care of yourself. Otherwise, I think I would have just probably gone in a downward spiral of depression if I didn't do things like that. So right now it's focusing on myself, going out to these events, having some fun. The other events I'll be doing, I'm flying out to Florida to teach a private crypto class in October 5th and 6th. I'm back here, and then I go out to Orlando Money Show on the 16th and 17th, and then and that's it. No, F45 physical location. You got to go to a physical location. And at least here's the deal. If I could do workouts in my house, but I'm not going to push myself. I'll get to the point I'm like, I'm done. But when you go to the F45, you've got your partner sitting next to you. And not to sound rude or anything, but one of my partners was this guy who was probably 200 pounds heavier than me. Like, we're talking grossly obese. He was a big, big dude. Very short, too. And I was giving up on my set. I was like, I'm done. I look over and he's still going. I'm like, there's no way I'm letting this guy beat me. And you just push yourself. You work out harder. You got a better community. So, you live in the sticks. Oh, bummer. Well, maybe you can find out some gym near you. I just think, you know, our physical health is, I would argue, equally as important as our mental health. And I'm working on the mental health part as well. So, yeah, I'm just about to take a next step up and start doing more supplements so I can put on a little bit more mass. So ideally, I'd like to gain about 10 pounds of more muscle, and that would give me a lot more confidence about myself. So anyway, that's my story. There you go. Travel and have a good time. Enjoy. I will. I'm going to be traveling quite a bit. But most of that's for work. The one next week is all for fun. And I will have a lot of pictures to show you when we get back. A lot of pictures to get back. All right, group exercise challenges you, especially if you're competitive, and I'm very competitive, Big Eb, as you know. All right, guys, that's going to do it for me. As far as economic announcements for tomorrow for Thursday's session, I'll bring those up here. There really is not much to go off of. Today was the big news. We have no, this is not unemployment claims. Oh yeah, typically Thursday unemployment claims. You do have a rate announcement for the UK. Notice here, I think this is really the interesting part for tomorrow. They're expected to keep rates right where the same, but if you guys see these three numbers above it, I know it's hard to see for some of you on your phone. The previous reading was what's called a 0.54. That means nobody wants to raise, 5 wanted to lower, and 4 wanted to keep it the same. Right now, no one wants to raise, 1 person wants to lower, and 8 people are expected to keep it the same. So it looks like the UK is going into a holding pattern, which is different because they've been cutting it pretty much every couple of months, and now they're holding. So it seems like they go 2 meetings with a hold, and then they cut. 2 meetings, and then cut, and then 2 meetings, cut. So there we go. That's pretty much the most important part for tomorrow. And if you look at the British pound USD, which I'll bring that up here for you right now, here's the GBP USD. The British pound was on a nice rise, although you have a pretty significant reversal pattern that happened today, a little shooting star. That may bring some downside movement, but be very careful because, as you know, those rate announcements can cause havoc on price action. And that's pretty much it. You have the Bank of Japan as well with a tentative rate announcement, but they're not expected to change anything either. Chris says, you need that motivation to push. I agree. See, yep. Yeah. We'll see. I definitely need the motivation. I think it just keeps me focused. Otherwise, I'm obsessing on someone who doesn't care about me at all in any way, shape, or form. So why should I obsess on someone like that? So focus, and I should obsess on myself, right? We should all obsess on ourselves and make ourselves better in every way we can, whether that's physically, mentally, socially, and if going out and helping other people is what your calling is and makes you feel good about yourself, then by all means, go and do that. But we should all be in that spirit and mindset that you go, hey, it's good to be alive. I love where I'm at, and I feel great about myself. We should do that more and more and more. So, Technician JD, I don't know about jacked. I just want, I want to get a little bit bigger. I've always been a small guy, so a little bit more. There we go. Okay, everybody, that's it. My Tony Robbins session is over. You'll feel better about yourself, everybody. Just sign up for my class today. All right, I will see you all tomorrow for our Thursday session. We're going to have Mike Larson of The Money Show on, so if you have questions for Mike or myself, email me at tradermerlin@gmail.com. Put it down below any of those YouTube videos as well, and I will see you guys tomorrow. Take care.